Welcome back to MEV Explained. So far, Arbitrage has meant one token and two venues. Buy with cheap on Uniswap, sell it dear on Sushi. But there's a bigger game. What if you send one token on a lap through three different pools and it comes back as more of itself? That's triangular arbitrage. Today we build it, watch a loop turn 10 WETH into a profit, and then learns the rule every searcher lives by. Make the loop too big and you rob yourself. Let's go. Here is the idea. Last time Arbitrage was one token with two different prices on two exchanges. Triangular arbitrage is a loop instead. You start with one token, trade it for a second, the second for a third, and the third back to the first, all in one transaction. Now if you multiply the three exchange rates together and get exactly one, you'd end up where you started minus fees. But if the three prices are even slightly inconsistent, that product comes out above one and you finish the lap with more than you began. The profit doesn't live in any single pair looking cheap, it lives in the loop. And this isn't a toy. Cyclic arbitrage is a huge slice of all the value extracted on decentralized exchanges. Prices across pools drift apart every single block, and bots are constantly scanning thousands of possible loops, 2 hops, 3 hops, 4, looking for a cycle whose rates multiply above 1. Whoever spots it and lands their transaction first keeps the money. It's one of the main reasons the mempool is a battlefield. Let's build the simplest version and see it pay. Here's our loop on one screen. 3 pools. WETH to USDC priced at 3000. USDC to DAI, and this is the one that's off. It hands out 1 and 500 DAI for every USDC. When DAI should be about 1 to 1. And DAI back to WETH again at 3000. Follow the lap. 3000 USDC becomes 3150 DAI thanks to that 5% bump, and that converts back to slightly more than 1 WETH. The whole loop multiplies out to about 105, a 5% edge before fees. That one mispriced pool is the crack and the loop is the crowbar. We'll build it in Foundry. One quick honest note, a real triangular ARB needs 3 deep pools, and on a live Ethereum fork only the WETH pairs are deep enough. The others are too thin to trade cleanly. So like our DeFi episodes, we build a controlled little lap. 3 pools we seed ourselves, so the numbers are clean and the lesson is clear. Everything runs locally. We start with a skeleton, a mock token, just a name and balances, so we can mint and move it. And a pool, our miniature market maker. It holds 2 tokens, cashes their reserves, and lets you swap one for the other. The token is done. The pool's 2 functions are still empty. Let's fill them. Here's the pool. Sync just caches the reserves, how much of each token the pool is holding, and swap is the heart of it. It works out which token is coming in, pulls it from you, and takes a 0.3% fee. Then the constant product formula. The output equals the other reserve times your input over this reserve plus your input. The important part is what that formula does as your trade gets bigger, and we'll see it bite in a minute. Finally, it updates the reserves and pays you out. Know the lab, we deploy 3 tokens, WETH, USDC and DAI, and 3 pools connecting them in a ring. 2 are priced fairly, WETH to USDC at 3000 and DAI back to WETH at 3000. The middle pool, USDC to DAI, is the mispriced one. We seed it with 5 million USDC against 5.25 million DAI, so it pays out 1 and 500 DAI per USDC. That tiny dislocation is the entire opportunity. Everything else is a fair market. And here's the loop itself as a test. We take 10 WETH and send it around the ring. Swap it for USDC, that USDC for DAI through the mispriced pool, and the DAI back to WETH. 3 swaps, one after another, no capital left behind. The final line is the whole claim. The WETH we ended with is greater than the 10 we started with. If that passes, the lap made money out of nothing but a price inconsistency. Run it and read the lap. Under 10 WETH goes in. Hop 1 turns it into 29,600 USDC. Hop 2 through the mispriced pool gives 30,800 DAI. Notice it jumped, that's the 5%. Hop 3 brings it back to 10.138 WETH. We started with 10, we finished with 10.14. A small clean profit pulled out of thin air by walking the loop. Green means the arbitrage worked. Now the lesson every searcher learns the hard way, same loop, same pools, but this time we send 100 WETH instead of 10. Watch, 100 WETH comes back as only 82, a loss of nearly 18 WETH. What happened? The trade was so big it moved the pool's own prices against us. Every hop, the constant product curve steepens as you push more through it. Your own slippage ate the 5% edge and then some. There's a sweet spot. Big enough to be worth it, small enough not to move the market. Find the wrong size and the arbitrage pays you nothing or worse. A quicker recap. Arbitrage isn't only buying low on one venue and selling high on another. It can be a loop through 3 or more pools, and you profit whenever the cycle's exchange rate is multiplied to more than 1. A single mispriced pool is enough to open the door. But size is everything. Push too much through the loop and your own price impact wipes out the edge. Real searchers spend most of their effort finding not just the loop, but the exact right amount to send around it. A quick word, building these MEV demos safely and clearly takes real work. If it's useful to you, the wallets are on screen and there's a Ko-fi link below. Every tip funds the next one. Thank you. That's a triangular arbitrage, 1 token, a loop through 3 pools, and a profit that lives in the cycle if you size it right. So far, every ARB we've done has been risk-free and victimless. Next episode, that changes. The sandwich attack, where a bot profits by squeezing its trades around yours, and you get the worst price. Subscribe so you don't miss it. Tell me in the comments what to break down next, and I'll see you there.